Hey guys, Jared Wesley here of Live Traders, and I put together a really badass educational video for you guys. It's about 30 minutes. It's on support and resistance, also a little bit of trade management, add and reduce. You want to stick around and check out this video, guys. It's really educational, and you're going to learn a lot from it, and you're going to become a better trader because of it. Jared Wesley, Live Traders, check it out. So guys, the point I was just making, okay? The point I was just making is this. The breaking of this trend line right here is the first sign, right? The first sign, very early sign that perhaps this trend is changing, right? Lower high, lower high, lower high, still a lower high, still. But we've finally broken the trend line and the moving average. So it's the first warning sign to say, you know what? Possibly this stock is no longer going to be in a downtrend. But in order to know that for sure, we need what we call confirmation. So in this particular case, you can get multiple forms of confirmation, right? You could have the stock consolidate out right here, right? Consolidate out and then break above. Or you can do what this stock did. This stock pulled back and put in a double bottom, right? It pulled back and put in a double bottom. That double bottom after the bounce is the confirmation that this stock is no longer in a downtrend. But, this is key, in order to be able to buy it, you need it to break this pivot because it has to put in a higher pivot high. For this stock to actually be transitioning, it has to put in a higher pivot high. See, right here we're in a stage 4 downtrend. Declining moving average, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. We break the trend line, break the moving average. We retest the prior bottom. This is a W bottom, okay, as it says up here, W bottom, and we bounce. Now, if you want to buy a very, very small position here, like a half lot, a third lot, a quarter lot, you can do that, and that's okay, right? That's fine. But do not go full here. Why? Because you're not in an uptrend yet. You're still in a transition. You went from a stage 4 downtrend to a double bottom stage 1, right? But we really don't want to buy until we're in a stage 2 uptrend, or at least an early stage 2. So if you want to nibble some here, right, get in maybe a little bit at 42.50 and put your stop at 41.50. Give it a little bit of room under the double bottom. That's okay. But I would not, I mean, if you're going to risk a couple $1,000s on this thing and you have a dollar stop loss, maybe take 500 shares, right? Take a quarter risk, a third risk. And then when it finally breaks this area, see this red line? This is resistance. When it finally breaks this area at 46.50, look for a pullback pattern and then get full. So you nibble a little down here, it breaks above the moving average, breaks above this pivot high and this pivot high on a wide range igniting bar. But notice the igniting bar, although it breaks the pivot, gets far from the moving average. Far from the moving average means a pullback is likely, so let it pull back. Pulls back right here, lower high, lower high, lower high, higher low, higher low, higher low. What is this? This is a wedge. This is a flag, whatever you want to call it. It's a buy setup technically, but it's also a flag and a wedge. Comes back towards the moving average. Where do you buy it? You buy it above this little tiny green bar right here. You buy it above this area right here, right there. Call it 46.50. Now remember, you bought a little, you nibbled just a little bit down here at 42.50. So now you add back at 46.50. So you're going to have a cost average somewhere around 46, 45.50, right? If you bought a quarter lot and then added the other 3 quarters back, right? So now your cost average is below 46, and guess where your stop is? Right here. Right there. 45.50? Somewhere around there? Maybe 45, but that's way down here. I'm going to say about 45.50 on your stop loss. So you entered the rest of your position at 46.50, but your cost average is about 45.50 because you got a little bit in at 42.50. So guess what? Guess what this trade is now? It's free. This trade is free. Because now you have a full position, and your stop loss and your entry are almost exactly in the same spot. Because you nibbled some down here. And then, boom, first bar. That's a 60-minute chart. So within 60 minutes, you're already up almost $3. Almost $3. You're share sized for about a $1 stop. But it's a free trade. So within 60 minutes, you've already made 3-to-1 on your money. If you're risking $2,000, you just made $6,000. If you're risking $1,000, you just made $3,000 in 60 minutes. But that's not the goal. The goal is to get it back up to this prior pivot. Why? Because that's the next target area. The next prior pivot high, which is right around 50-ish, right? Give or take 50, maybe 51, is your first target. So you ride it up, and there you go. Boom, first target. So you would have made almost $5 on your first target, 5-to-1 on your money. 5-to-1 on your money at $1,000 risk is $5,000. $2,000 is $10,000. Guys, 60 minutes. This is meant to be a swing trade where you're going to hold it for about 2, 3, 4, 5 days. Within the first 60, 120, 180, 4 hours? Now, granted, this is the next day, but in the first 4 hours, you just made a lot of money. Then you get a super wide range red bar that might, let's be honest, might shake you out. My stop would be at break even by this point, right? For sure, above break even. All right, that's the original trade. If you want to shoot for the big money, you're going to have to let this thing pivot as long as it stays above the moving average. And it did. And then you can add some back right here again at 48 and raise your stop to 47, maybe a little under, 46.50. Add 48. So maybe you sell half up here at 50. Sell half, lock in 2 to 3 to 1, right? It went 5 to 1, 6 to 1, lock in half of that. Add back right here, raise your stop. Shoot for the next target, which is back up here at $55. Or, guys, if you're a little jittery, a little nervous, dump it all at the first target. Why? It's 5-to-1 anyway. This is a perfect swing trade. Short term. When I mean some swing trades last 2 and 3 weeks, this is one that would last 2 or 3 days. And that's the perfect kind. Not just because it lasted 2 or 3 days, but because the pattern is literally perfect. You broke the trend line. That's a warning sign to say, hey, you know what? Sellers are losing control. Buyers are starting to gain control. Now I need confirmation. The confirmation's the pullback. Nibble some. Don't go full. Why? Because we haven't broken resistance yet. Once you break the resistance and pull back, now you get full. Make sense, guys? I hope so, because that's trading 101. And if you stick to these types of patterns, you will rarely lose money. Almost never will you lose money. Okay? Sure, some of them won't work. That's just the nature of trading. 80% will work, 20% won't. But the problem is many of you out there are pushing it. Or you're getting full on the double bottom, and then it shakes out. See that little doji bar right there? You get full right here. Go, ooh, I'm going to get at the bottom. I'm going to be the first person in this. Ego. FOMO. Fear of missing out plus ego. Guys, if you're right, yes, that's the bottom. I agree. But if you're right, it's going to get back to 55 anyway. So you don't have to go full boat here. Give yourself some flexibility. Give yourself a little bit of room. Half lot, third lot, quarter lot. I wouldn't probably go a half lot. Quarter lot, third lot. Then add back on the way up. That's how professionals do it. Okay? And if you noticed in doing so, you incurred very little risk. You never risk more than a quarter R. Why? Because by the time you added, your stop and your entry were the same. Okay? So let's take a look at a few more ideas, guys. Okay? This is a similar concept as what we just looked at, but now instead of having a swing trade, we're looking at it as an intraday trade. Okay, so a little different concept. So what I mean, excuse me, is the approach is a little different. Okay, let me explain why. So as always, we start with a higher time frame. All right, in this case, that higher time frame is the daily chart. So we have a stock that broke above resistance right here at $60, right there. Went higher to 65 or 66, pulled back, moves up, and you get this little red resting day. Little red, that's good, because after a wide range green bar, Well, your stock's probably a little tired, so it rested. Next day you wake up, it gaps up. But you still have this area to contend with, right around 67 bucks, give or take, right? Right around $67. So you really don't want to take it at 65, because you want to wait for it to break this pivot high, right? That's where all the last of the sellers are. They sold it off down here. Get over the sellers and the buyers will step up. Okay, so let's drill down to a 2-minute chart. Drill down to a 2-minute chart. Now, what is the same here is the double bottom retest, but it's happening in a different area. Okay, this is a daily chart, which is our guide, which is our bias, and the 2-minute is our entry. So now you have a stock that immediately pops off the open. Now, do you want to buy this at 66.50 with a stop at 65.80? You could, but this is a very aggressive entry. One, I happen to take. AAOI, right? Gave it to you guys in the room at 931, 66.50 by 65.50. Okay, give it extra room, and this thing ripped. Went right up to 68. I mean, it went $1.50 quick, 1.5 to 1. But that's an aggressive entry. For the newer trader, I don't know if I would recommend this entry right off the open. Okay? So what do? Wait for the pullback. So it pulls back where? Towards the moving average. And it leaves a bottoming tail. All right? Now here's the key. Do you want to get full here? Well, you could, right? Because this is a legitimate buy setup. Lower high, lower high, lower high, lower high, lower high. Lower lows, lower lows, lower lows. Bottoming tail, doji bar, rising moving average. You could certainly make a strong argument to buy this stock at 66.50 right here, which is basically the original entry anyway. Okay? And put your stop at 66 or the low of the day, your choice. But you might say to yourself, gosh, that's a really big move up. And we've seen a lot of stocks bounce and shake. I'll wait for the shake. So you have a choice here. You can wait for the retest, which might never happen, right? You can wait for the retest, but it might never happen. It might just trigger and rip. You could also go full right here. Go full, which means 66.50 by 65.50, and then maybe get shaken out. Or you can do the tweener. You can take a half position here, give it a little extra room, right? Take a half position at 66.50 and give it room below the low of the day, just in case it shakes. If it shakes, you're not going to get affected because you're below the low of the day. You're like 65.50 down here, right? Talked about that over here, 65.50. And then when it retests, get full. So it retests at 66.30, get full. Now raise your stop to 66. So now what do you have? 30-cent stop loss. Maybe with the cost average, maybe a 40-cent stop loss, right? If you got in at 66.50 and then you added full 66.30 plus 66.50, the cost average is 66.40. So you have a 40-cent stop loss. It's a much safer entry. Why? Because you got the retest. Okay, the retest is what? It's confirmation of strength. That's what a retest is. Retest is confirmation of strength. This particular retest happened above the moving average on a really nice daily gap in an already strong stock. Pops, you get a little nervous here because of the red bar. You go, oh man, great pop, but what about the red bar? Then it consolidates. If you wanted to, guys, you could even add again at 67 and raise your stop to 66.50. Then you have a cost average of about 66.75 with a stop at 66.50, and then blast off. This ultimately almost becomes a wedge, a little mini wedge right here. But the point that I'm trying to make here is this stock offered you multiple opportunities. It offered you really aggressive opportunities, like a 2-minute high. It offered you a less aggressive pullback entry, and then it offered you the least aggressive retest entry. So I look at this and think to myself, let's find the middle ground. Perhaps let's not be so aggressive. Now, I was personally very aggressive with this, but let's not be so aggressive. Let's wait, so take a half position on the pullback and then add back on the retest. Now, remember, we might never get the retest. That might not ever happen. But at least you have a half lot, and your target's 68 bucks. The prior pivot high is that target. You're in at 66.50, right? Taking a half lot, giving it some room, get your target at 68. But in this case, it pulled back. So now you can get full. Your cost average 66.40, your stop 66. By the time you get to 68, what? It's a $1.60 move. Now all of a sudden it's a 4-to-1 gain. 40-cent stop, $1.60 target, 4-to-1 gain. Now, if you want to go next level, you add again at 67, and now it's a 5, 6, 7-to-1 gain. Right? Whew. So you can see how we started with the daily chart, gapping over a red bar and gapping over a pivot. And we drilled down to a 2-minute in this case, and got an aggressive entry off the open, a less aggressive pullback entry, and then a really safe retest entry. This is where you want to be trading most of the time. It's about what? 2, 4, 6, 8, 10, 12, 14, about a 9:45 to 9:50 entry, a retest around 10 o'clock, and you're done by 10, 15, 10:30. You've traded an hour to make 4-to-1. Now, I'm out at 2-to-1, but that's okay. This thing went more. That's a really good entry, guys, right? Now, let's take a look, a similar look, but we're just going to vacuum it. What I mean by vacuum it is we're just going to look at the 2-minute and not look at the daily, okay? So, we have a gap up, okay, that pulls back and leaves a bottoming tail. Now, could you drill down to a 1-minute and buy this at $7.50 right there? Yeah, you could. It's just aggressive, right? It's just very aggressive to do that. Put your stop at 740, you got 10-cent stop, which is fine on a $7 stop. But you might say to yourself, well, gosh, that's not a lot of confirmation. No, it's not. You're gapping up, and perhaps it's a good gap. But that wide range red bar has to be a little bit concerning to you. The fact that it gapped up and immediately pulled back is not generally what we want to see. Now, if this pulled back the same size, but it did it on 3 or 4 bars, that's different. That's a controlled pullback. This is a panic pullback. This is people taking profits. And you have to ask yourself, well, gosh, why do they want to take profits? It just gapped up over resistance, all right, potentially. Why do they want to take profits? Because maybe they think that's the top. So when you see that level of profit taking on big volume, it's concerning. So again, you might be tempted to take this at 750, but let me tell you, let me be clear. You can do that, but I would not go full boat. Again, back to like we did a couple slides ago. Take a partial position here. Partial, quarter lot, third lot, okay? Give it extra room. So instead of using a 10-cent stop, why don't you take a half lot or a third lot and give it a 20-cent stop with the intention of adding back? It's a much safer entry. Okay, so get in at 750. So let's say you want to risk $1,000 bucks. You're gonna need 10,000 shares of this thing. Get in with 3,000 or 4,000 shares and give it down to 730. Okay? Take 3,000 shares and give it 20 cents. It's like a half risk. Okay? Then when it bounces, pulls back, now you have your confirmation. It's above the moving average, bottoming tail, doji bar. The entry's even a little bit better, 745. Put your stop right there at like 740. So imagine you take 3,000 shares at 750. You add another 3, probably 4,000, 5,000 shares right here. More than that, really. You're going to add more than that. You're probably going to add like 7,000 or 8,000 shares here. Because you're going to want to have about 12,000 shares if you're going to do 1,000 risk. Why? Because your entry is getting better. Your entry is now, instead of 750, you're getting in at 745. It's going to be about 747, 747.50. So now you only have an 8-cent stop. So now you need about 12,000 shares for 1,000 risk, of course. It bounces. First target, high of the day, right there. High of the day is 765. You're in at 747.50. 765 is about 18 cents. Your stop loss is 8 cents. It's 2-to-1. It's more than 2-to-1. Okay? More than 2-to-1. Bounces up to that area, pulls back to about 752, 53, and then goes like this. Wow, right? Ends the day, not ends the day, but peaks at $8.30, and you're in at 747. You sell half up here at 765, 2 to 1, ride the back half up for a bigger move. Now, you could get it all out at 765 if you want. 2 to 1's fine. Make a couple grand in what? I don't know, you're in it right here at about 936, 935, whatever it is, and you're out by 10 o'clock, 10:05, right there. That's fine. So 30 minutes of your life, 25 minutes of your life for $2,000. We just got done talking about how the average American makes less than 60 grand a year. That's $200 to $250 a day. And they work 8 hours for that. 8 hours for that. And in 30 minutes, you could have 500, 1,000, 2,000 bucks. But the key here is patience. Don't go full on this first pullback. Do not go full on the first pullback. Okay? Go partial. Then when you get the retest confirmation, the confirmation that buyers really are interested in buying this stock, then you get full. Okay? All right. One more, guys. This one is less of a W bottom, guys, but it's on the same ilk as the add and reduce strategy that we're talking about. Okay, so this case, we're using a 60-minute chart instead of a daily chart. You can use either. But notice, big gap up. It's an extended move from $150 to almost $170, 167, right? Right here, big, huge move up, pulls all the way back and does what? Puts in a new low here. Not a bullish sign, right? The rip up is very bullish. The pullback is not so bullish. In fact, it's extremely bearish. So what are we going to need? Confirmation. Bounces, pulls back, bounces, pulls back, bounces. But here's the key, guys. What's it doing here? It's putting in a higher low, and a higher low. So the buyers are stepping up earlier each time, right? Bounced, pulled back. Buyers are stepping up at 146 instead of 142. Bounces, equal top. So sellers are still here, right? Sellers are still coming in. Pulls back, 146, 147, 147. Buyers are stepping up a little bit earlier. They stepped up at 142. They stepped up at 146. They stepped up at 147. Notice they're stepping up earlier and earlier and earlier. What do? We bounce. But what happens again? We get smacked at the 155 area. Sellers are still here. We pull back to 150. Buyers step up. So 142 buyers step up, 146 buyers step up, 147 buyers step up, 150 buyers step up. The buyers are stepping up sooner and sooner and sooner and sooner and earlier. That is commitment from the buyers. But here's the rub. You still don't want to buy it till we can get over 154 to 155. This area, like 154-ish right there to 155. Why? Because it's proven that, yes, the buyers are stepping up earlier, but we still haven't been able to break this line at 154. So we're not going to touch it until it breaks the 154, 155 area. When it does, we should have room to like 167. Why? Because that's where the sellers came in before. Now, another thing that's key here. By the time we finally buy it, we're above the moving average. Okay? Flat top, higher lows, that's an ascending triangle. We're above the moving average. So, let's go from the 60. Let's drill down to the 1 minute. Yep, I said it, the 1 minute. There's the gap, okay? We can see it. Stock closed at like 150, 150 the day before. Gap's up close to 154. Well, isn't that the line we've been waiting for? 154-ish, give or take? Yes, it is. Puts in a bottoming tail doji bar, green bar, red bar, another retest. We're all about buying this at 154. You're going to get in at 154 and use the low of the day as your stop. Now, if you want to get like really aggressive, you can use a stop right here at like 153.50, 153.70. But here's the rub, guys. Almost definitely 931, 933, 935. This stock is very spready and whippy. So when things are spready and whippy, do you want to give it more room on the stop loss or less room? Answer, more room on the stop loss. You want to give it more room. Why? Stocks are whippier and spreadier. It's more protection. If you're right, and this stock does go higher, it's going to go significantly higher, and that extra 50 cents is not going to matter, especially if you look to add back. So it triggers at 154. There it is, NVIDIA 154 by 153.40. I chose a slightly tighter stop on this, okay? 153.40 is right there. Instead of going 153, I went right there, okay? It takes off and goes about 50 cents. And then what happens? It gives you a 3-bar play. Wide bar, narrow bar, you can add at 154.45, and now you can raise your stop to 154. Wow, so your cost average is going to be 154.22, and your stop's going to be 154. Yeah, we went from a 60-cent stop to a 23-cent stop. Rip, and then from there it goes up to 155.50. So you goes $1.20 now on a 23-cent stop. That's 5-to-1 on your money. You're done. You can buy the pullback and add, but you are done. And you can see, I put this pre-market in the room, NVIDIA over 155. I called it at 933, 154, 153.40. Okay? See there? You're going to raise your stop, raise your stop, raise your stop. This is how you accelerate your winners, guys. All right? Using add and reduce. But I've shown here 2 examples, right? We go back here, okay, to where we're being very, very cautious with our entry, right? Why? Because we're still in a downtrend. To over here, where we're being a little bit more aggressive because it's breaking an area that's been there for 1, 2, 3, 4, 5 days. So when it breaks that area, we want to get in as soon as it breaks that area. See the difference? One trade, uber patience. Take your time, wait for the retest, nibble a little, add back. This trade on NVIDIA, super aggressive. Why? Because it broke this line that's been sitting there for 5 days. And as soon as it breaks it, you want to get in it. In this case, that's a 935 entry. Both are equally valid and both are equally reliable. But different scenarios require different angles or levels of patience. One requires a massive amount of patience. The one requires you to be more aggressive. But what's the one thing that's true on both of these? 1, they were both good patterns. 2, they gave you the quote, the look. They gave you the look that you wanted, right? Before we got in this NVIDIA, we knew we needed it to break 154. We weren't going to take it until it did. It did. It gave us the look. So you get it. You get in. If it gives you what you're asking the stock to do, then you get in. Right? It's like kind of that saying that when you go to a car dealership and they say, if I can get you the right payment at the right this and that, will you buy today? And that's their way of pinning you down, saying, well, yeah, if I meet your criteria, will you buy for me today? Well, if this stock meets our criteria, will you buy it today? Will you take it? The answer is yes. Right? So back over here on the W bottom, I will not take it full down here. I'll nibble some. Basically, this is saying, tell me more. You're the salesman saying, well, if I give it to you here at $42.50, will you buy for me today? And you say, maybe, tell me more. And then he tells you everything you wanted to hear over here. He meets your demands. So you say, yeah, I'll buy from you. Yep, we're good. Same thing on NVIDIA. Break 154, I'll buy from you today. Oh, there it is. There's the beautiful pattern, the shakeout. I'll buy from you today. Now, I use the car analogy because I think it's appropriate. But I don't want to get into talking about cars because you shouldn't be going into a car dealership and actually listening to any salesman that tells you, if I get you the payment you want. Excuse my language, but fuck payments, guys. Okay? Get out of the payment mode. I'm not going to go off on a tangent, I promise. But that's the wrong question. The question you should be asking is, how much is the car, not how much is the payment. But we'll move on from that. So you saw in 2 scenarios here how one, we needed a lot of patience, and in one, we needed to be aggressive. Why? Because both of them gave us what we were looking for. So as soon as the stock gives you what you're looking for, you take it, whether it's aggressive or whether it needs patience. But you have to buy it at that point. Why? Because all the stars lined up and it gave you everything you asked it to do. So if it's giving you everything you asked it to do, why wouldn't you buy it? The answer is you wouldn't. You have to buy it. You don't even have a choice. Okay? Does that make sense? I hope that makes sense, because that's how you make money as a trader. And then on top of it, you have to manage properly in between. I just talked about entries and adding and reducing. If you sell too soon, well, you're going to go to the poorhouse anyway. Management's another topic. I touched upon add and reduce a little bit, but management's a whole nother topic. Okay? So again, I hope you guys enjoyed that. I hope you got a little bit of learning and education out of that. And I hope that for 2019 that you'll use and apply some of these tactics, because patience is very hard in trading. But what's harder than patience is requiring a stock to give you what you're asking. And if it doesn't, you wait. If it does, you get in as soon as it does. I want you to think about that thought process in your head. I require certain criteria. If those criteria are met, I push the button unequivocally no matter what. Got it? I hope you guys enjoyed that video, and I hope you guys learned a little bit about support and resistance and how and when to be aggressive versus waiting and being patient, guys. All right, that's what trading is all about, is knowing when to push the button, knowing when not to push the button, and managing in between. So I hope you learned a little bit in that video. Guys, also in the next couple days, I'm going to be doing a 2018 year-end review, showing my account statements, my P&L, all that good stuff. So stick around for that as well. And also, if you haven't already gotten Trader's Guide to Success, you need to get this book, guys. This is a free ebook, free ebook at livetraders.com, livetraders.com. Go download it. When you go to livetraders.com, it's at the top of the page. Click the little button and get this free ebook. Also, if you want to build a trading plan for 2019, this is $37, guys. It's super cheap. It's a paperback book. We will send you a paperback book and a PDF file for $37, guys. That's nothing. This thing's 70 pages on how to build a profitable trading plan. So, trading plan essentials, Trader's Guide to Success. You definitely need this because it's free, but if you want to be a successful trader, you got to have this too, guys. $37 is nothing. Jared Wesley, Live Traders. Check out some of my other videos and subscribe, guys. Take care.